Hello and a warm welcome. You've joined us on Commodity Corner. I'm Ashesha Advaryu, and as a part of our special coverage for India Investor Week here on ET Now, today we turn the spotlight to commodities as an asset class. We will explore how you can invest in commodities, how is investing in commodities different from investing in equities, and why they are a critical part of a well-diversified portfolio, on what that means for your investment strategy. And to help us navigate through all this, we have two very special guests joining us on the show. Feroze Azeez, Deputy CEO of Anand Rathi Wealth, and Anindya Banerjee, SVP and Head of Commodity and Currency at Kotak Securities, are now joining us. Gentlemen, thanks so much for taking your time out and speaking with us here on ET Now. But before we come to you, let's first understand how commodities are different from equities. So for instance, when you buy equity shares, you purchase a part of that company, which implies ownership in that company, which also means that you have a claim on company's assets and profitability. However, unlike equities, commodities are goods that can be bought and sold. When you trade in commodities, you are actually buying and selling these goods. Equities are classified either based on sector or market cap or stock type, while commodities can be classified as metals, which include industrial metals like copper, zinc, lead, aluminium, and precious metals like gold and silver. In equities, you earn returns through dividend and capital gains, but in commodities, returns are driven by price fluctuations in the commodity market, which is in turn driven by demand and supply dynamics. Equity trading can be done on BSE or NSE, while commodities can be traded on MCX, which is Multi-Commodity Exchange, or NCDEX, which is National Commodity and Derivatives Exchange. Let's go to our guest then. Feroze, first coming to you. Let's first understand from Anindya actually, if someone is just starting off, how can he or she actually invest in commodities? For instance, if I want to invest in equities, we just have to open an account with a broker and go about it. But how does it work for commodities? Help us understand.
See, commodities is not very different from opening an account for equity trading. So I'll just explain the whole thing. So there are two major exchanges in commodities. One is MCX, the other one is NCDX. MCX is well known for its non-agri commodities and NCDX for its agri commodities. Now, in order to access those exchanges, you need to have an account with one of the leading brokers. Generally, many of the stockbrokers, they offer you access to commodities market. So you just need a segment activation in case you're already doing equities trading, or else if you are opening an account fresh, you have to just follow the same account opening process which happens for equity. So that's how you will be able to access the futures and options on MCX as well as NCDX.
Well, absolutely. So trading or investing in commodities is clearly as simple as trading or investing in equities. But Feroze, coming to you then, should one invest in commodities to diversify his or her portfolio? What are the advantages of investing in commodities? And help us understand, does it really act as a good hedge against inflation and other political uncertainties?
Shesha, what happens is should one invest in commodities depends on their current status. Okay, what is their other alternative? See, basically there are four assets which have stood the test of time. One is equity, the other is real estate. These are two growth assets. And debt and commodities can be a protection asset. They can help you reduce your risk. Real estate and equity can give you the upsides. So point one I'm trying to make is whether you're going to be investing or not is going to depend on whether you're using it for what purpose. That's point one. Point two, commodities have to be invested. If you want to invest in commodity from a hedge perspective or a diversification perspective, you have to first understand there are 2-3 levels of commodities. Because commodity is a very large umbrella. You can have agri commodities, you can have bullion. So what you have to do is you have to first categorize them into 3 different heads. Bullion commodities, which are metals, bullion energy, and the last one is agri commodities, which are also called soft commodities. So I would say you should not get into soft commodities or energy commodities, but you should begin with metal, which is more tangible and more comprehensible. Is the point I would like to make.
All right, and we'll talk about the types of commodities in a greater detail in just a bit. But Anindya, coming to you, help us understand how big is the commodity market in India versus equity markets, and are volumes and liquidity high enough for investors and traders to actually execute the trades the way we do in equities?
Absolutely, because if you just compare the statistics, so premium turnover on NSE is around 80,000 roughly on an average daily basis. On MCX, it is around 4,000 crores. So that's roughly 5%. And over the past 2-3 years, we have seen an exponential jump in volumes. For example, the commodity market on the future side is doing around 2 to 2.5 lakh crores a day on a single side basis. So the liquidity is there, but it's just that you have to select those top 10, top 12 commodities in which you have to operate. It's not that every commodity which is listed has liquidity.
All right, let's also shift focus to the instruments through which we can invest in commodities. Now, you can either take physical possession of commodities, say buying a gold bullion, or you can invest or trade through futures contracts on exchanges. But guess what? These are not the only two ways. You can invest in commodities through mutual funds and ETFs or exchange traded funds also. Anindya, coming to you, we do understand that we can invest in commodities through various mechanisms, that is futures, mutual funds, ETFs, or even physical delivery. But which is the most liquid and most preferred route of investing in commodities?
See, here I would like to segregate between gold and silver and the rest of the commodities. So if you are talking about, let's first talk about the non-gold and silver commodities. In that, the most liquid way for a retail individual to take exposure is the futures market, because a physical market will be very cumbersome to handle. So the futures market will be the most liquid and easily accessible market for a retail individual. I'm not talking about a corporate. And when it comes to gold and silver, we have a lot of options and all of them are liquid, but each one has its advantages and disadvantages. For example, physical gold and silver is something which we can take, but there are disadvantages like there can be a haircut on the when we want to sell. Plus, there are various other things, storage charges, etc. Then we have the SGBs, the sovereign gold bonds. Again, you have to hold till maturity. Then you have the ETFs, as you said, but they have the issue of tracking error, and you have to also pay 100% of the money upfront. But when we talk about gold or silver futures on MCX, so the advantage is that you have to just pay the margin money. Let's say that's 15%, and the rest 85% of the capital you can keep it in a liquid fund, and that gives you an augmented return. Yes, the disadvantage of futures market is that the gold and silver is trading at a premium in the futures, which means every time you have to roll your position on expiry, you have to do it at a premium. But even considering that cost of rollover and considering the amount of money that you may make from the liquid funds and etc., it sets it off. So overall, I would say that depends on where you're looking to take exposure, whether it is bullion or it is non-bullion. Accordingly, you can decide.
Well, absolutely. So those are the pros and cons of the various instruments through which you can invest in commodities. But Feroze, coming back to you, let's talk about gold in particular. Say if I want to invest in gold, which instrument would you prefer personally for investments in gold?
Yes, if you're looking at commodities and if you're looking at metals, and if you want to restrict your usage to gold, which is what I personally recommend, because silver is also a very sporadic commodity. There have been 10 years of silver giving no return in rupee terms. That has not happened with gold. So gold is a more predictable commodity. Now, if I have to first start with gold, and if I have to answer your question of which is the more cost efficient and effective measure, effective platform to participate in gold, I would say if it's a short term, then you should look at gold ETF. If it is long term, you should look at sovereign gold bonds in the secondary market, because the primary issuances don't seem to be coming anytime soon. That's from a gold standpoint. Especially after the budget which just went by, the maiden budget of the third term of the Modi government, they have reduced the tax implication on ETFs and fund of funds. So gold funds and ETFs, taxation has become better, which is 12.5% long term. Having said which, So ETFs are very cost effective, both on the cost of the management and the tax cost as well. So that's what I think one should focus on. Because if you look at the efficiency ratios of different commodities, if you look at gold, gold has given a 10.8% return on a 3-year rolling basis. And the risk it has thrown up in standard deviation is 5.5. So if you divide return by risk, which is where efficiency lies, gold is the best commodity in terms of efficiency, but still worse off than equity. The efficiency ratio of equity on a 3-year rolling basis is 2.5 and of gold is 1.98.
Well, absolutely. And also wanted to understand what are the main drivers that drive prices of commodities? How do demand supply dynamics and geopolitical factors impact commodity market? Feroze, this question is for you.
The commodity market have different variables and different commodities have a different demand and supply mechanism. Commodities also go through paradigm shifts. See, that's why it's a little more complex instrument. See, equities are more correlated. If the top 50 stocks of Nifty today are up today, it's quite likely that the next 50 are also up today. But that's not true with commodities. They can move in opposite directions to each other, significantly opposite directions. So that's one. So to answer this question, you have to first decipher which commodity are we speaking about. Now, if I look at commodities in general, they, of course, geopolitical uncertainties can have a different impact on gold, especially when sovereign countries are collecting gold, left, right, center. But the usage of gold from an ornamental standpoint is going down. India has been the largest consumer of gold in the world from 1990, if I'm not wrong. And now India's consumption pattern is changing. Diamonds, for example, if I count them as commodities, not so well traded on the exchanges, of course, not traded on the exchanges, but they're transparent commodities, have gone through a paradigm shift after lab-grown diamonds have come. So point I'm trying to make is, first choose the commodity you're trying to understand the forces of. Every commodity has different forces, point one. Point two, commodity usage and the paradigm shifts in their usage is far more important for a long-term investor. And I think gold ornamental value is coming down, but because of the kind of uncertainty and the global political uncertainty especially, and the war situations which we have seen time and again from Ukraine and Russia to the unsettled Middle East today, I think gold has a larger preference from a government sovereign perspective. So that's one thing which I think has the largest impact on commodities.
All right, so now that we have understood how you should invest in gold, let's also talk about the different kind of commodities that are being traded on exchanges. Anindya wanted to understand, we have often heard about gold futures or say industrial metal futures, say copper or aluminium futures. But what are the other types of commodity futures that trade on exchanges here in India, and especially soft commodities?
See, as I said at the start, the NCDX is well known for agri-commodities. So which are the agri-commodities? So if I look at the top 5 commodities, that is the guar complex, so guar gum and guar seed. Then we have turmeric, which is spices, coriander, which is again that. Then we have castor seed, and then we have cottonseed oil cake. So these 5 commodities basically comprise your bulk of the volumes on NCDX. We have also commodities from the softs like gur and other things. We have grains, we have pulses, but those are not liquid. So liquidity is concentrated in these top 5-6 commodities which I mentioned in NCDX. On MCX, it is as you said, yes, it is non-agri. So it is metals, which is precious metals, base metals, energy, for example, natural gas and crude oil. So these are the ones which are the most liquid, and investors and traders can easily trade in them.
So those are the types of commodities that are being traded on Indian exchanges. Let's now take you through some important and interesting facts and figures from the world of commodity. Organized commodity exchanges have had a long history. Commodity futures trading first started in Japan, and first organized futures market was the Osaka Rice Exchange, which was set up in 1730. Way back in the 17th century, Osaka emerged as the major trading center for rice in Japan. Rice bills represented the right to take up delivery for an agreed quantity of rice at a future date but at the current price. This was, of course, precursor to futures back then. We'll slip into a short break. We'll be back and we'll focus on some more nitty-gritties of the commodity market. Stay tuned.
Banking partner SBI, the banker to every Indian. In association with New Virtus GT line, style to wander.
इस गुस्ताखी की सजा सिर्फ मौत है। चाचा, राजा साहब, आपकी गाड़ी इंश्योरेंस रिन्यूअल के लिए एजेंट 10 बार फोन कर चुका है। एक बार प्राइस कुछ बताता होगा, दूसरी बार कुछ और फिर भी कोई क्लैरिटी नहीं। एग्जैक्टली।
इसीलिए खुद से रिन्यू करो। नो झंझट, नो कंफ्यूजन और सही प्राइस।
एको
एग्जैक्टली।
गद्दी पे तो आपको होना चाहिए। कार इंश्योरेंस हो लेना तो एको चेक कर लेना।
I think the United States, from everything I know, wants a deeper, more significant alliance with India.
India is the only place where most of the youngsters, 65% of people are young, and that's the advantage we have.
There's a lot of talent out there which is coming up with solutions for the future of India.
मैं समझता हूं कि भारत एक इमर्जिंग नहीं बल्कि एक रिसर्जेंट सुपर पावर है।
Presenting partner IDFC First Bank, always you first. Co-presented by Adani. Associate partner Dream Sports, make sports better. Knowledge partner Amrita Vishwa Vidyapeetham, come become. An initiative by Times Influence.
Hi guys, happy Diwali.
लम्हा खुशियों का खिलने लगा है दिल की रोशनी से हर गहना सजने लगा है ज्योतियों से हर खरंगना लम्हा खुशियों का।
हैप्पी दिवाली।
लंच हो रहा है हाँ? सर लीजिए ना। करेला। तुम क्या लाए हो? सर करेला। करेला लुक्स अमेजिंग।
डिलीशियस। बोरोसिल ग्लास लंच बॉक्सेस, खाने को बनाए खास।
Welcome back. You're still tuned into Commodity Corner right here on ET Now. And now that we've discussed how and why you should invest in commodities and the different types of commodities, let's move on and understand how gold has performed versus Nifty over the last few years. We tried to analyze return data of gold and Nifty of the last 25 years. And gold data shows that during the period 2004 to 2009, and 2009 to 2014, gold has actually outperformed, but equity has clearly delivered consistent returns over the corresponding period. Does it then make sense to invest in gold as an asset class? Let's ask Feroze then. Feroze, coming to you, if we go by the last 5, 10 or 20-year returns, gold has clearly given aggregate lower returns as compared to Nifty. So then why would one want to invest in commodities? Do hedging benefits actually overweigh lower returns from equities? Does it make sense to invest in commodities as a hedging mechanism?
Shesha, I personally think I would not look at gold as an alternative to equity. That's why I said there are two growth assets, real estate and equity compete with each other. Debt and gold, to my mind, compete with each other. Why? Because debt is today in India at 10-year GSEC, Government of India, if you lend, which is risk-free, is about 6.9%. Taxation is marginal tax rate. But gold, if you compare with debt, both on the taxation and the return perspective, is higher. Of course, gold is not as safe as debt, but if you're looking at long-term, especially given how rupee depreciates because of the higher interest rate, gold becomes not just a hedge to equity, but also becomes a hedge to currency, which debt is not. So I would not want to compare a straight comparison between gold and equity. I would rather, if I am sitting on 40% debt, which quite a few Indians love debt for no reason, It is like smoking or alcohol. Of course, you enjoy it in debt. You get so much comfort and happiness when you own debt. But in the long run, it will definitely harm you against inflation. So I would say these two assets fight, and I'm sure gold wins over debt any day.
So then, Feroze, what would you recommend to our viewers? How much percentage of portfolio should actually be allocated to commodities, especially gold?
You see, there are different thumb rules because it's a one-to-many communication. You have lakhs of viewers. I would want to say I'll give one thumb rule. Your debt portion should never be greater than twice your gold portion. So if you have 10% in gold, you can have 20% in debt at best. So if the numbers, if you can have your debt plus gold portion together as 50-50.
Feroze, one more follow-up question. Does an SIP in gold or silver like equities make sense, or absolutely no?
I personally think anything which is meant for protection need not be staggered because the volatility in gold is lesser than in equity. I would not require. I'm trying to hedge something. So co-hedge karna seems a little double hedging kind of, because SIP helps you gather an asset over longer periods of time because of the price volatility. My risk mitigation tool, I don't want to be so bothered of mitigating risk in a risk adjustment tool.
Well, absolutely, we get that point. But now that we have understood how and why we should invest in commodities, Anindya, help us understand what are the risk factors that are involved in investing in commodities, and what are the factors that one should keep in mind in order to deal with the volatility in commodity market.
See, we have to understand one major thing is that because we are dealing with derivatives, we have to be very careful with our risk management, because here the risk of loss can be much more than what we had anticipated because of the margin call. So we need to have proper stop losses and position sizing, which is critical. And it's just not important for commodity, it's for any derivative segment. Apart from that, certain kind of risks are very typical to commodities, that is currency risk. For example, a lot of these commodities are internationally traded and we are simply trading their import parity price. So, for example, gold, copper, crude, natural gas, etc. So when the exchange rate fluctuates, the USD INR, that has an impact on the prices. Similarly, when there is a fluctuation in the dollar internationally, that has an impact on the commodity. So when the dollar is weaker, generally the commodities tend to appreciate, and vice versa. So exchange rate risk or currency risk is important. Then is geopolitical risk, something which we saw in crude since 1st of October. When the geopolitical tensions increase in the oil producing nations, we tend to see a lot of volatility in the oil prices. And third is weather risk. So that directly impacts your agri-commodities. That also impacts significantly commodities like natural gas and to a certain extent oil as well, crude oil. So weather risk also plays a lot. And finally, I would now talk about the economic risk. So for example, interest rate moving up or down, economic outlook, that will have a significant impact on your base metals, on your precious metals. So when a trader or investor is operating in the commodities market, he need to track these factors so that he's able to manage his own financial risk well.
So those are the risk factors that you need to keep in mind when investing in the commodity market. But Feroze, as a new investor, if I want to start investing in commodities, how do I really track the commodity market, and what are the various factors that drive these moves? How should I assess global trends to actually forecast commodity prices?
See, this is a very complex game. If you're a new investor, you should not do that at all. Right? Forecasting requires so much degree of regression and second degree differential equation to be solved. So forecasting is something which requires a lot of mathematics. If you're a beginner, start with the most conventional commodity, which is there in the futures market. You can use the futures market to track its trends. Anything which is a global commodity like gold, you should look at how the dollar prices have moved. If you just Googled gold dollar prices for the last 80, 100 years would be available on an Excel sheet right on Google. You can understand what are the risks, which is the worst period of gold. If you look at the worst period of gold in dollar terms is from 1980 to 2002, where gold in dollar terms was negative. Understand the worst if you want to understand an asset class. before investing, it's important to understand the worst situation of anything you invest in. Best situation does not require preparations.
Well, absolutely. It's important to understand the worst before investing in an asset class. Feroze and Anindya, thanks so much for taking your time out and speaking with us here on ET Now. But let's go on then. Let's go across and listen into some important commentary as well. Sridhar Sivaram, investment director at Enam Holdings, is very bullish on gold, and he says that everyone should have at least 10% of their allocation to this yellow metal. Let's listen into his rationale.
I've been a big bull on gold. I mean, my basic view is at least you should have 10% allocation in gold. The 20-year performance of gold is very similar to the Sensex returns, roughly 14% CAGR. And you can take any period, 1 year, 3 year, 5 year, roughly gold has matched Sensex. Maybe there are periods where Sensex has done better and there are periods where gold has done better. But the point here is more on asset allocation, and the other thing which people underestimate, that gold is a hedge against the currency also. So if our currency over 5 year, 10 year depreciates at a CAGR of 3%, this is a hedge which gives you that return plus the gold returns. I've always maintained that the Indian woman is the best fund manager. By just buying gold, she has outperformed most fund managers over the last 20 years. And we keep cribbing about, some of my, male fund managers who don't like my comments, saying that, this is India's current account deficit is going out of hand. Gold, yeah, because of gold imports. But people don't realize that the gold loan market is now almost 8 lakh crores. So the argument that this is a lazy asset, doesn't generate any economic value, is also proved wrong because of the huge gold loan markets that we have.
So that's the word coming in from Sridhar Sivaram, who believes that at least 10% of your portfolio should be allocated to gold. Let's move ahead then, and let's tell you some other facts and figures from the world of commodities. Amount of snow and rain in an area can also be traded as a futures contract or option. In fact, not just that, hurricane futures are also traded on the CME Hurricane Index. With that, it's a wrap on this edition of the show. Thanks so much for tuning in.